In this video, I am going to discuss about multi-product break-even analysis. In the previous video, we discussed about break-even point for single product in greater detail. So let's recap what we have learned about break-even point in the previous video. What is break-even point? Break-even point is where at which a business neither makes profit nor loss. Simply this means this is the point at which profit and loss is equal to zero. At this break-even point, we can recognize these characteristics. Sales revenue is equal to total cost and the profit and loss is equal to zero. Total contribution is equal to total fixed costs. This is because total profit is equal to total contribution minus total fixed cost. Since at the break-even point, profit is zero, total contribution will be equal to total fixed costs. We discussed about this graph as well. You have to have a thorough understanding about this graph. The y-axis depicts the cost and revenue, whereas the x-axis depicts the quantity or the volume. Now you know about these lines. This is the fixed cost line and this is the variable cost line. Combining these two lines, we can draw the total cost line, which starts from the fixed cost amount and is parallel to the variable cost line. And finally, we have the total sales revenue line. The break even happens at the point where the total sales revenue line and the total cost line intersect. So the x-axis value is the break even point in terms of volume. And the y-axis value is the break even point in terms of revenue. And these are the formulas we discussed about under single product break-even analysis. We can calculate the break-even volume by dividing the total fixed costs by contribution per unit value. And using this break-even volume value, we can calculate the break-even revenue, which is equal to break-even volume multiplied by the selling price per unit. And then we can also calculate the break-even revenue value using another formula. In this formula, we divide the total fixed costs by the CS ratio and we can calculate the target revenue to make profit. This is equal to total fixed costs plus target profit divided by the CS ratio. This is an extension of this formula if you can see. Simply we have added the target profit value here so that we can calculate the target revenue that the business has to make in order to make that target profit. And then we discussed about the margin of safety. We can calculate the margin of safety in terms of volume and revenue. So the margin of safety in terms of revenue can be calculated by budgeted volume minus break-even volume divided by the budgeted volume multiplied by 100%. And we can calculate the margin of safety in terms of revenue, which is equal to budgeted revenue minus break-even revenue divided by the budgeted revenue and then multiplied by 100%. Now let's discuss about the main topic of this video lesson, which is multi-product break-even analysis. When there are more than one product, it is known as a product mix, which means now the business is selling more than one product at the same time. Break-even point is where at which a business neither makes profit nor loss. So the concept of break-even point is same as for the single product break-even analysis and for the multi-product break-even analysis. Since different products have different CS ratios, formulas under single product break-even analysis cannot be used when there is a product mix. A weighted average CS ratio has to be calculated. Simply this means we cannot use the formulas we used under single product break-even analysis when it comes to multi-product break-even analysis. This is because now there are more than one product. So each product has its own CS ratio. So when it comes to multi-product break-even analysis, we have to calculate a weighted average CS ratio. Now let's do this example. Company Y manufactures and sells three products which are product A, product B and product C. This means now there is a product mix. This is because now there are more than one product. The proportion of the product mix is said to be 5 to 3 to 1 respectively. The first question is, what is the total number of products in the product mix? So how we can calculate this figure? In order to calculate this figure, we need the proportion of the product mix, which is 5 to 3 to 1. This simply means in this product mix, there are 5 units of product A and 3 units of product B and 1 unit of product C. So in order to calculate the total number of products in the product mix, we have to add these values together. So this is the total number of products in the product mix, which is equal to 9. What is the total number of product A in the product mix? So in this product mix, there are 9 products. So how many of them are product A? As now we know, there are 5 units of product A in this product mix. What is the total number of product B in the product mix? There are 3 units of product B in this product mix. What is the total number of product C in the product mix? There is only 1 unit of product C in this product mix. What is the proportion of product A in the product mix? So how we can calculate the proportion of each product? So how many units of product A in this product mix? There are 5 units of product A. And what is the total number of products in the product mix? There are 9. So 5 divided by 9 is the proportion of product A in the product mix. What is the proportion of product B in the product mix? There are 3 units of product B in the product mix and the total number of products in this product mix is 9. So this is the proportion of product B in the product mix. Finally, we have to calculate the proportion of product C in the product mix. There is only one product of product C in this product mix. So 1 divided by 9. This is the proportion of product C in this product mix. Now let's discuss about the multi-product break-even volume. We can use this formula in order to calculate the multi-product break-even point or the multi-product break-even volume, which is equal to total fixed costs divided by the weighted average contribution per unit. If you can remember, we can calculate the break-even point for single product by dividing the total fixed cost by the contribution per unit value. But when it comes to multi-product break-even volume, we cannot use this formula because now there are more than one product. So we have to use the weighted average contribution per unit. This is how we can calculate the weighted average contribution per unit. We have to take the summation of contribution per unit multiplied by the number of units in the product mix of each product and divided by the total number of products in the product mix. And then we can calculate the units in the break-even product mix for each product, which is equal to multi-product break-even volume multiplied by the proportion of the product in the product mix. This assumption is very important. We assume that the product sales mix is constant. Now let's do this example so you can understand the multi-product break-even point. Company Y manufactures and sells 3 products which are product A, product B and product C. The proportion of the product mix is said to be 5 to 3 to 1 respectively. Total fixed cost is $8,000. Calculate the break-even volume and number of units in the product mix for each product. So they have given us the data for product A, B and C. First of all, we have to calculate the contribution per unit for each product in order to calculate the weighted average contribution. So for product A, contribution per unit is equal to selling price minus variable cost, which is equal to 8. For product B, 20 minus 15, which is 5. For product C, 16 minus 9, which is equal to 7. So these are the contribution per unit for each product. Now let's calculate the weighted average contribution. So for product A, contribution is equal to 8 per unit multiplied by the number of units in the product mix. So this is the product mix 5 to 3 to 1. So there are 5 units of product A. So 8 multiplied by 5. For product B, the contribution per unit is equal to 5 and the number of units in the product mix is equal to 3. For product C, 7 multiplied by 1 divided by the total number of units in the product mix, which is equal to 5 plus 3 plus 1, which is equal to 9. This is equal to 6.888. Let's round it off to 6.89. So this is the weighted average contribution per unit. So this is a dollar figure. Now we can calculate the multi-product break-even volume, which is equal to total fixed cost divided by the weighted average contribution per unit. So the fixed cost amount is equal to 8,000 divided by 6.89. This is equal to 1161.1. Let's round it off to the next whole number 1162. We rounded this value to the next whole number because we cannot sell a portion of a product. We have to sell a whole number of products. So in order to break even, company Y has to sell 1162 units. Now we are done with the first section of this question, which was to calculate the break-even volume. Now let's do the second part, which is to calculate the number of units in the break-even product mix for each product. So this is how we can calculate the number of units of each product in the break-even product mix. So this is the break-even product mix. Now we have to calculate how many product A's in this product mix and how many product B's and how many product C's. So this is how we can calculate that amount. So for product A, let's consider the break-even volume, which is 1162, and then we are going to multiply this value by the proportion of the each product in the product mix. So there are 5 units of product A in the 9 units of product mix. For B, 1162 multiplied by, there are 3 units of product B's in the product mix and there are 9 products in the product mix. So for C, 1162 multiplied by 1 over 9. There are 645.5 units of product A in the break-even product mix. Let's round it off to 646 units. And there are 387.3 units of product B's in the break-even product mix. Let's round it off to 387. And finally, there are 129.1 units of product C's in the break-even product mix. Let's round it off to 129. This should equal to 1162. This is how we can calculate the number of products in the break-even product mix for each product. Now let's discuss about the multi-product break-even revenue. This is the formula we can use to calculate the multi-product break-even revenue, which is equal to total fixed costs divided by the weighted average CS ratio per unit. If you can remember, for single product, we calculated the break-even revenue by dividing the total fixed cost by the CS ratio per unit. But we cannot use this formula here. This is because now there are more than one product. So this CS ratio should be a weighted average value. This is why we use the weighted average CS ratio per unit in order to calculate the multi-product break-even revenue. And this is how we can calculate the weighted average CS ratio per unit. Weighted average CS ratio per unit is equal to the summation of contribution per unit multiplied by the budgeted sales units for each product divided by the summation of selling price per unit multiplied by the budgeted sales units. This will equal to total contribution divided by total sales revenue. If they have not given the budgeted sales units figures and they have given the proportion of the product mix, you can still use that figures. In the early example, which was 5 to 3 to 1, you can use either these values, or if they have given us the budgeted sales units, we can use directly those values. Then we can calculate the sales revenue in the break-even product mix for each product, which is equal to break-even revenue multiplied by the proportion of the product in the product mix. Here we also assume that the product sales mix is constant, which means this proportion is constant. Now let's do this example. Company Y manufactures and sells three products, which are product A, B and C. The proportion of the product mix is said to be 5 to 3 to 1 respectively. Total fixed cost is $8,000. Calculate the break-even revenue and sales revenue of each product at the break-even revenue. So first of all, we have to calculate the weighted average CS ratio. In order to calculate that figure, we need individual contribution per unit figures. So let's calculate the contribution per unit figure for each product. For product A, contribution is 8. For product B, contribution is 5. For product C, contribution is 7. Now we can calculate the weighted average CS ratio per unit. So for product A, the contribution is 8 multiplied by the budgeted sales units, or here they have given us the projected sales units. So we can either use this value or this value. We can use either 5 or 1500. So let's use the figure 5. For the product B, 5 multiplied by 3. For the product C, 7 multiplied by 1 divided by, for product A, selling price per unit is 10 multiplied by 5 plus, for product B, selling price is 20 multiplied by 3. For product C, selling price is 16 multiplied by 1. So the weighted average contribution per unit figure is equal to 0.4920. Let's round it off to 0.49. Now we can calculate the break-even revenue for multi-product, which is equal to total fixed cost divided by the weighted average CS ratio per unit. So the total fixed cost is 8,000 divided by 0.49. This is equal to 16,326.5. This is a dollar figure. So this is the break-even revenue for the multi-product mix. Now we are done with the first part of this question. Now let's do the second part, which is to calculate the sales revenue of each product at the break-even revenue. For product A, the break-even revenue is 16,326.5. We multiply this value from the proportion of product A in the product mix. So there are 5 units of product A's in the product mix, and there are total of 9 units in the product mix. For product B, 16,326.5 multiplied by 3 over 9. For product C, 16,326.5 multiplied by 1 over 9. For product A, this is equal to $9,070.27. Let's round it off to $9,070. For product B, 5,442. For product C, 1814.5. So these are the sales revenue figures for each product at the break-even revenue. So these three values should equal to the break-even revenue value. This is equal to $16,326.5. Now let's discuss about the topic of target profit. This is the profit that a business targets to achieve. So in order to achieve a target profit, they have to achieve the target revenue to make that profit. So this is equal to total fixed cost plus target profit divided by the weighted average CS ratio. So the target profit will add to the total fixed cost and we divide it by the weighted average CS ratio. Now let's do this example. Company Y manufactures and sells three products which are product A, B and C. The proportion of the product mix is said to be 5 to 3 to 1 respectively. Total fixed cost is 8,000. Calculate the target revenue to make 1,000 profit. This is the same example as before. So we already calculated the weighted average CS ratio per unit which is equal to this value 0.49. Now we can calculate the target sales revenue to make profit, which is equal to total fixed cost plus target profit divided by the weighted average CS ratio. So the total fixed cost is equal to 8,000. So the target profit is 1,000 divided by 0.49. So this is equal to 18,367.3. So this is the target sales revenue that the business has to make in order to make a $1,000 profit. Note that when the business makes a profit, this value is always higher than the break-even revenue. This is because only after the break-even revenue, business can make a profit. Let's go back and see the break-even revenue value, which is 16,326. This is 18,367. Break-even revenue is less than the target sales revenue. Now let's discuss about the multi-product margin of safety. We discussed about the margin of safety under single product break-even analysis. The formula is the same. We can calculate the margin of safety in terms of volume, which is equal to budgeted volume minus break-even volume divided by the budgeted volume multiplied by 100%. This will give us a percentage value. If we want to calculate the absolute margin of safety in terms of volume, we can calculate it by budgeted volume minus break-even volume. This will give us the absolute value of the margin of safety in terms of volume. We can also calculate the units of each product in the margin of safety product mix. Now we know this formula. The only difference is now we have to use the margin of safety in terms of volume multiplied by the proportion of the product in the product mix. We can also calculate the margin of safety in terms of revenue. This is the same formula we used under single product break-even analysis, which is equal to budgeted revenue minus break-even revenue divided by budgeted revenue multiplied by 100%. If we want to calculate the absolute margin of safety in terms of revenue, we can calculate it by budgeted revenue minus break-even revenue. This will give us the absolute value of the margin of safety in terms of revenue. Now you know this formula. We can calculate the sales revenue of each product in the margin of safety product mix, which is equal to margin of safety in terms of revenue multiplied by proportion of the product in the product mix. Now let's discuss about an important subtopic under break-even analysis, which is operational gearing. You may have heard the gearing term before, but here we are not going to discuss about that particular gearing. The gearing you may know is debt over debt plus equity or debt over equity. Here we are not going to discuss about this particular gearing. Operational gearing is a separate topic. Operational gearing is the relationship between fixed costs and variable costs in a company's cost structure. So simply operational gearing is the relationship between fixed costs and variable costs in a company's cost structures. This has nothing to do with the debt and equity. This is purely based on the relationship between fixed costs and variable costs. It means the extent to which fixed costs are present in relation to variable costs. Simply, this is the measurement of how much fixed costs are there in the company when it compared to variable costs. When a company has high fixed costs and low variable costs, it is said to have high operational gearing. Simply, this means if the fixed costs are higher than the variable costs in the cost structure, it is known as a high operational gearing. Higher the fixed cost, higher the operational gearing. Conversely, when a company has low fixed costs and high variable costs, it has low operational gearing. This means if the company has low fixed costs and high variable costs, it has low operational gearing. Lower the fixed costs, lower the operational gearing. Simply, we can calculate the operational gearing by dividing the total fixed costs by total operational costs. Total operational costs is equal to total fixed cost plus total variable cost. This is the simplest way to calculate the operational gearing in a business. So, what is the relationship between operational gearing and break-even point? Operational gearing directly influences the break-even point by affecting the level of fixed costs, the contribution, and the sensitivity to sales volume changes. Businesses with high operational gearing have a higher break-even point, while those with low operational gearing have a lower break-even point. Now we know this formula. This is the formula we use to calculate the break-even point, which is equal to total fixed costs divided by contribution per unit. This formula is used when there is only one product. So as you can see, the fixed cost is directly influencing the break-even point. If the fixed cost increases, the break-even point also increases. If the fixed cost decreases, the break-even point will also decrease. This is the direct relationship between the break-even point and the total fixed cost. So, if the business has a higher operational gearing, what will happen to the break-even point? Higher the fixed cost, higher the break-even point. So, if the business has a lower operational gearing, what will happen to the break-even point? Lower the fixed cost, lower the break-even point. Which means when there is a higher operational gearing, the business has to sell more products in order to cover its total cost. When the operational gearing is lower, the company has to sell less products in order to cover its total costs. High operational gearing will lead to high break-even point. Now you know this, which means the business has to sell more products in order to break even. Low operational gearing will lead to low break-even point, which means the business has to sell less products in order to break even. This will be quicker than the high operational gearing business. So this is the profit volume chart. Y-axis depicts the profit and loss. This is the zero. X-axis depicts the quantity or volume of units. And let's consider this company A and this company B. Let's consider they only have one product. These lines depict the contribution of product of each company. Can you guess which company has the high operational gearing and which company has the low operational gearing? Let's go through these notes. High operational gearing will lead to high break-even point. There are two break-even points for each product, and what is the high break-even point value? Which is this? This is the higher break-even point value. So, company A has the higher operational gearing. And point 2. Low operational gearing will lead to low break-even point. which is this. This is the lower break-even value. So company B has the low operational gearing. We can extend these lines and find the answer as well. This is the fixed cost for company B. This is the fixed cost for company A. Company B has the low fixed cost amount, which means they have low operational gearing. Company A is high, which means they have high operational gearing. So remember, if the fixed costs are high, the break-even point will be also high. If the fixed cost is low, the break-even point will also be low. Now let's discuss about the final topic of this video, which is profit volume graph. You know the profit volume graph already because under single product break-even analysis, we discussed about this graph. For multi-product break-even analysis, there is also a profit volume graph. This is a bit complicated than for single product break-even analysis. These are the steps to follow. You are not required to draw any graphs in your OTQ exam. For case study exams as well, you are not required to draw any graphs. But for the case study exams, you need to know about these steps because you may be required to explain these steps how to draw a profit volume graph for multi-product break-even analysis. So have a good understanding about these steps. First of all, you have to calculate the CS ratios for each product separately. Then you have to arrange the CS ratios in descending order. Descending order means highest to the lowest value. Let's say there are figures 1, 6, 9, 8. Let's say these are the CS ratios for 4 products. In the second step, what you have to do is you have to arrange these CS ratios in descending order, which means highest to the lowest. So what is the highest value? Highest value is 9. The second highest value is 8. Then 6 and the lowest value is 1. This is the descending order. Also remember, higher the CS ratio, higher the profitability of that product. Lower the CS ratio, lower the profitability of that product. The third step, draw a graph where x-axis depicts the volume of products, y-axis depicts the profit and loss. And the fourth step is to determine the total fixed costs amount and mark this value on the graph. And then starting from the total fixed cost amount, draw the contribution lines for each product continually in the above arranged descending order. Slope of the each line will be the CS ratios for each product. This simply means gradients of these lines will depict the CS ratio for each product. And then draw a line which connects the total fixed cost amount and the endpoint of the least profitable product's contribution line. And then the point at which this straight line intercepts the x-axis is the break-even point for the product mix. The slope of this straight line is the weighted average CS ratio of the product mix. The point at which an individual line intercepts the x-axis is the break-even point if the product are sold in the above descending order rather than selling as a constant mix. Now let's do an example so you can understand these steps better. This is the example we discussed throughout this video. So now what we have to do is we have to draw the profit volume graph. So what is the first step? The first step is to calculate the CS ratios for each product separately. So let's calculate the contribution first. Contribution per unit, which is equal to 10 minus 2, 8, 20 minus 15, 5, 16 minus 9, 7. So these are the contributions per unit for each product. Now let's calculate the CS ratio per unit for each product. 8 divided by 10, 5 divided by 20, 7 divided by 16. So we have calculated the CS ratios for each product. Now let's go back. The second step, arrange the CS ratios in descending order, which means highest to the lowest. First, we have to convert these figures into decimal values. So, 10 divided by 8, 0.8. 5 divided by 20, 0.25. 7 divided by 16, 0.437. Now we can arrange these values in descending order. What is the highest value? The highest value is 0.8. So 0 point is the highest value, then 0.437, then 0.25. So the highest value is 0.8, the lowest value is 0.25, which means we give the priority to product A, then product C, then product B, because higher the CS ratio, higher the profitability. The highest profitable product is product A, then product C, and then product B. The third step, draw a graph where x-axis depicts the volume of products, y-axis depicts the profit and loss. So we have the graph here. Y-axis depicts the profit and loss, and this is 0. X-axis depicts the volume. The fourth step, determine the total fixed cost amount and mark this value on the graph. So what is the fixed cost amount, which is $8,000? So we have to mark this value on this graph. 8,000 is a cost, so it will be below the zero line. So let's mark 8,000 here. This is the fixed cost. The next step, starting from the total fixed cost amount, draw the contribution lines for each product continually in the above arranged descending order. So we give the priority to product A first. So the first line represents the contribution of product A. They are expecting to sell 1500 units of product A. So let's mark this 1500, and this line represents the product A's contribution. This is the contribution line for product A, and the slope or the gradient of this line represents the CS ratio of product A, which is 0.8. Then we draw the line for product C because it has the second highest CS ratio. They are expecting to sell 300 units of product C. So 1500 plus 300, 1800. So the slope will be little lower for product C. And finally we have the product B. They are going to sell 900 units. So 1800 plus 900 is equal to 2700 units. And the slope is little lower than product A and C. So this line represents product B. Sixth step, draw a line which connects the total fixed cost amount and the endpoint of the least profitable product's contribution line. So this is the fixed cost amount, and starting from here to here, we are going to draw a straight line. So now we are done with drawing the graph. The seventh step, the point at which this straight line intercepts the x-axis is the break-even point for the product mix, which is here. This is where the straight line intercepts the x-axis. So this is the break-even point for the product mix. Simply this means this is the multi-product break-even point. We calculated this figure earlier. Let's go back. It is this value, 1162 units. So this is equal to 1162, which is less than 1500. So the break-even point is to the left side of 1500 value, which is correct. Eighth step. The slope of this straight line is the weighted average CS ratio of the product mix, which means the slope of this straight line is the weighted average CS ratio. What is the weighted average CS ratio? It is 0.49. So this is equal to 0.49. And finally, the point at which an individual line intersects the x-axis is the break-even point. If the products are sold in the above descending order rather than selling as a constant mix. So they are talking about this point here. So this is the break-even point if the business decides to sell product A first, because product A is the highest profitable product, rather than selling them in this proportion. If they sell product A separately, this will be the break-even point. So these are the points you need to know when it comes to profit volume chart. We are done with the question. Draw the profit volume graph and mark the break-even point for the constant product mix, which is this value 1162, and break-even point if the highest profitable product sells first. The highest profitable product is product A. So the break-even point will be this. Let's calculate that value. So the break-even point if they sell product A first. So this is equal to total fixed cost, which is 8,000, divided by contribution per unit for product A, which is equal to 8. So the break even point is equal to 1000 units for product A, which is also correct because this will be 1000, and this is located to the left side of the 1162 value. Thank you for watching. See you in the next video.